Hey everyone, today I'm going to be comparing two very different ways to tap into your home's equity. A traditional HELOC and a newer model called a home equity agreement, or HEA for short. If you've been weighing the pros and cons of each, this should help make things a lot clearer, because while they both give you access to cash in your home, they work in completely different ways. And which one makes a perfect fit for one person might make it a total nightmare for someone else. So in this video, I'm going to break down exactly how each one works, what they actually cost, and the kind of trade-offs most people don't find out about until it's too late. And by the end, you'll know which one is safer, smarter, and more realistic for your situation, especially if you're trying to avoid high interest debt, unpredictable payments, and strict bank requirements. So let's start this all off with the basics. A HELOC, or home equity line of credit, is what most people think of when they hear tapping into your equity, right? It's a line of credit from a bank that uses your house as collateral. You're approved for a maximum amount and you can pull from it as needed. It's kind of like a credit card, but backed by your home. Now, the upside is you only pay interest on what you use, but the trade-off is it's still a loan. That means monthly payments, variable interest rates, and a repayment phase that kicks in whether you're ready or not. And if you fall behind, your home is absolutely on the line here. On the other hand, the home equity agreement works more like a partnership. You get a lump sum of cash up front, and instead of paying it back monthly, you agree to share a portion of your home's future value when you sell or refinance. There's no interest, no monthly payments, no income required to qualify. You still own your home, stay on the title, and control when you settle, be it in 30 years or whenever you move. But this isn't a borrowing, it's sharing. So that gives you flexibility now, but it means that the true cost won't be fully clear until later on, either when your home sells or when the agreement ends. Because both these tools have a price, but the difference is when you feel it, right? A HELOC, it does not wait. From the moment that you pull money, the meter starts running. Now, it'll just be interest at first, but once the draw period ends, usually after about 10 years, those payments get real. You might go from paying like 180 bucks a month to nearly 800 practically overnight. And that's if rates haven't gone up in the meantime. It's manageable if your income is steady and you plan for it. But if you're in between jobs or your budget's already tight, it can get overwhelming really fast. And HEA works the opposite way. Feels weightless at first. No interest, no bill. The money lands in your account and life just gets easier. You can finally catch up on repairs or clear out high interest credit cards. But when you go to sell or refinance down the road, that's when it lands. It's gonna cut into the proceeds, and even though you knew it was coming, it'll still sting a bit. So one asks for money now, the other down the line. And depending on your situation, the timing might matter even more than the number. Now, here's the part that you're not gonna find on an advertisement, right? With a HELOC, the risk isn't just making payments, it's how that line of credit ties your profile up. If you try to refinance later or apply for something else, it can block you completely. You got a second mortgage on your record, and lenders, well, they don't really like that much. And if your home value drops or your credit takes a hit, your HELOC lender can just freeze your line or even call it due immediately. So you're not just borrowing here, you're giving the bank real leverage over your own future. Now with an HEA, the paperwork looks simpler. There's no loan, no monthly bill. That doesn't mean it's completely low risk. These agreements aren't always regulated the same way state to state. The protections can be a bit loose. Some don't spell out how the settlement actually works until you're way down the road. And if you do need to get out early, say you're moving or refinancing, they can push back. There are cases where an investor didn't like the sale price and held things up. So yeah, when everything goes smooth, both options can work. But when life changes, the fine print is what decides whether you're in control or not. So a HELOC usually makes the most sense if you got strong credit, stable income, and a clear goal for the money. Maybe you're planning a renovation or covering school costs, and you know roughly how much you'll need, and more importantly, when you'll be able to pay it back. If you're the kind of person who budgets down to the cent, and you don't mind a little rate fluctuation, this can be a lower cost option that works long term. But first and foremost, you have to qualify, and you have to stay on track the whole way through. An HEA, on the other hand, can be a lifeline if you're stuck. Maybe your credit took a hit, or your debt to income ratio is too high for a loan, or your income just isn't as predictable month to month. You got equity in your home, you just can't access it through the usual routes. This gives you that access without adding pressure to your monthly budget. And that alone can make it worth it, even if it might cost a bit more later on. Now, maybe you're leaning toward one side already. You like the idea of a HELOC, pulling funds when you need to, keeping control, but the monthly payments feel risky. Or maybe the HEA stood out, no payments, more breathing room, but it's kind of hard to wrap your head around the future cost. That's where Point comes in, because they offer both options, but designed in a way that makes them easier to live with. If you're not in a place to take on more debt, Point's home equity investment gives you a lump sum of cash up front with no monthly payments and no income requirements at all. You stay on the title and you're the one who decides when to settle. If your home drops in value, you're not stuck making up the difference. They'll take a hit along with it. It's all built to keep things calm on your side of the table. But if you'd rather go with a credit line, they've got a HELOC that gives you access up to $750,000 from day one, but without the rate spike that most banks will hit you with when the draw period ends. It's set up for long-term budgeting, not short-term surprises. Because sadly, most lenders just kind of hand you a standard stack of paperwork and hope it works out. I really like Point because they actually looked at where people get stuck, and they tried to make those parts less painful. So whether you're stretching your budget now or trying to keep things steady long-term, this just feels a lot more doable than what most banks expect you to handle. So hopefully this helped you get a clearer feel for how HEAs and HELOCs actually work, and which one makes more sense based on how steady your income is, how long you plan to stay in your home, and how much risk you're really comfortable carrying right now. Because it's one thing to tap into your equity. It's another thing to be stuck with payments you can't keep up with or give up more value later than you realized you were signing up for. And the way Point is set up, it's one of the few options that will help you avoid both. And if you are thinking about checking out Point for yourself, there is an affiliate link down in the description. It doesn't cost you anything extra at all. We might earn a small commission on it if you use it though, and sometimes there are deals there that you won't see on their main site. Also, if you're a brand and you'd like to work with us or sponsor a future video, just reach out using the email in the description below. If you found this helpful, I'd always appreciate a thumbs up on the video. Subscribe to the channel if you want to see more comparisons like this. And if you got any questions at all, feel free to drop those in the comments. This stuff can get complicated, so I try to answer as many as I can. Guys, thank you so much for watching. I really hope you enjoyed, and I will see you in the next one.